We are joined by Steve Walsh. Steve, thanks so much for coming in.
Thanks, Julie. Happy to be here.
You know, a lot of different topics to talk about right now in fixed income, but I want to start with inflation because that's something that we've been talking about a lot with the price of commodities going up higher, with the price of oil going up higher. What is all of that going to mean for rates and for the bond market?
Yeah, I think you do need to have a decision on where you fall out on the inflation question. We'd be in one that says inflation stays fairly benign over the course of the next 6 or 12 months. Certainly QE2, the Fed's program to pump more money into the system, has raised the prospect of inflation down the road, but we still think here near term with decent growth but not great, with an unemployment rate that's very high, with relatively slow money supply, we actually don't see inflation becoming a problem as we move throughout 2011 and early 2012.
But how does it not happen if commodities continue the climb that they've been on? Do you think that they stop?
Well, the Fed's going to look at a broad measure of inflation, and certainly you can isolate certain items within the food category, commodities, obviously oil prices today that look to be problematic. But they're going to try to base their decision on monetary policy on a broad basket of goods and services. And that, from their perspective, and we would agree, is likely to stay fairly tame over the course of the next 12 months.
So we have been hearing from some companies that they're going to start to pass that through, but you think it's not going to be enough to really move the needle that much?
Again, with QE2, the prospect is higher. To think of a year ago right now, the amount of discussion about the Fed and can they exercise exit strategies from QE1. And the Fed actually raised the discount rate in February of last year as they were preparing for higher inflation. It never materialized. So we're more in the camp that there's certainly isolated pockets of concern, but as a broad basket, we'd be in the area that inflation is likely, it's bottomed out more than likely, but is likely to stay fairly low.
So what do you think happens with rates, say on the 10-year?
Yeah, see, based on that, you wouldn't get rates higher. People that are very bearish on interest rates or have to have a view of much higher inflation. We're kind of in a 3 to 4% camp, a broad range for the 10-year rate. If there was a risk that it breaks out of that range a little bit, we'd probably think it's the high side, but maybe 4 or 4.5 at the most. We're not in the camp that would have much higher interest rates for the U.S.
And what about the disconnect that we are really starting to see between the Fed here in the U.S. and their policy of quantitative easing, keeping rates very, very low, and what we're seeing certainly in emerging market economies, and then also now starting to potentially happen in the Eurozone as well with rates going up?
Well, the emerging economies are responding to what they should. They do see higher inflation there, and they should properly be raising interest rates. They have tied themselves to the dollar, so they've inherited our monetary policy, which is not appropriate for their countries. So they're doing the right thing by raising interest rates. Some might say doing it a little bit too slowly. I do think you bring up a great issue, which is this split on both sides of the pond between the ECB, who is sounding tremendously hawkish and giving signals that they might be raising interest rates as soon as April. And then on the other side, you have the Fed that arguably has been very dovish or maximizing monetary accommodation. So the split there. We'd fall out by saying the ECB is being too hawkish. Now, if they're just going to raise interest rates 25 basis points, that's probably okay. But the concept that they can begin a program of ever higher short-term interest rates, given the challenges that the peripheral countries face in Europe, we think is just not in the cards.
So if you're not seeing, as a result of all of what we're talking about, not a huge run-up in yields for treasuries, I know the biggest allocation that you guys have is to agency mortgages right now, which would seem to indicate some optimism on the housing front.
Yeah, we are modestly optimistic on housing, and agency mortgages don't really have a credit risk to them, so you really think away from the housing market in general, and it represents a big segment of the marketplace that we invest in, so we do have a large allocation to agency mortgages. The plans put forth by the Treasury really lead us to believe that agency mortgages are a very good, very safe asset with a decent yield. So that gives us the opportunity to have a pretty high weighting there. The credit side of the mortgage market, or the non-agency mortgage securities, anything issued by a private label company, we find really good value there as well. Now here, you need to have a more certain view on housing. And our view on housing is it likely stays fairly stable here for a while and bounces around for about a year before gradually picking up as we go into 2012. So we're not negative on housing. Those that are calling for an additional 10 to 15% decline in home prices, we wouldn't be in that camp. We could see maybe 5% decline, but largely think the bulk of the decline in housing and the problems within the housing market are probably past us.
So you think we've seen the bottom there?
Kind of close to the bottom. No, not looking for any huge recovery, but close to the bottom.
So when you look within non-agency mortgages, are you starting to look at the riskier side of things, or is it too early to do that?
Good question. We've stayed on the higher end. We're staying with larger larger loan balances, which tells you it's typically a person that makes more money. So we're staying in the prime and the Alt A categories, so not venturing down to subprime. I think the better opportunities or more certain opportunities can be found in larger loan balance securities of prime and Alt A category.
What about, when we talk about riskier, what about high yield? I mean, everybody's been riding the big wave that's been cresting of high yield, and then the enthusiasm has pulled back somewhat going into this year. What do you think happens there?
It's a great split with high yield. They've had two world-class years, up over 50% in 09 and 15% again last year. Today, the market yields roughly 6.5 or 7%. Question logically is there any more opportunity there? We still think there is opportunity in credit. The economy is doing a little bit better. Defaults are at an all-time low, and corporate balance sheets are great. The truth is you're not going to get spectacular returns, though. You're going to get pretty...
So what does that mean?
6 to 8%, maybe for this calendar year. Again, in context of the last 2 years, that looks pretty dismal, but still, in bond land, that represents, we think, a pretty good investment opportunity, especially with corporations that have such tremendous balance sheets today.
I want to turn back to the Fed in our remaining minute or so and talk about the end of quantitative easing, because it's coming at some point. We don't know when, if it's going to happen when this current program expires. I mean, can we get out of it in a way that doesn't sort of damage the economic recovery, damage the rate cycle? I mean, what happens?
You're asking the exact right questions. I think, and we can't look in history and find a situation where we could say, well, how did the central bank exit itself successfully from a $2.5 trillion balance sheet? There are enormous issues that are coming down the pike, I think, with respect to QE2, and it's a little bit uncertain. But you've raised the issues. When do they start selling assets? When do they actually remove the extended period language? When will they actually raise interest rates? Will they stop the program at the end of June? And can they do that effectively without doing one of two things? Without running the economy into the ditch and or waiting too long and letting inflation go higher?
Just one word, because we don't have much time yet. Can they?
Certainly they can, but I actually believe there's a lot of risk associated with that.
Okay. Steve Walsh of Western Asset Management, thank you so much for coming in. Appreciate it.
Thank you. Appreciate being here.